Okay bro, welcome to the new video. Today we will analyze this company, Main Street Capital Corporation, with the ticker MINN. And the reason why we will choose this company is because it has an amazing dividend yield of almost 6%, and for the American stock it's relatively cheap and it's trading at $43.77. And additionally, as you can see on their corporate website, they are paying monthly dividends, and those dividends are increasing over the years. So without further ado, we will analyze this company together with the help of this Excel table that I prepared. So we will analyze income statement, balance sheet and cash flow statement. And here, as you can see, I already pre-filled all the data and draw all the graphs. But still, I want to show you how I fill out this table, and total revenue we will do together with the help of this website called Macro Trends. So let's do it. We will split the screens like this, and here in the Macro Trends we will search for main, and then here we have revenue. You can click wherever you want, it doesn't matter. Then you go here to financials, and here you have the total revenue that we will use for the analysis. And now let's start typing it. So here we see 2013, and here we will also input 2013. So 116497. Okay, we have all the necessary data. As you can see here, we have now the most important aspects that we will analyze. So as you can see, total revenue is increasing over the years, except here on the COVID crisis, which is completely normal. Okay, gross margins are usually meant to be more than 40% for an outstanding company. And here, as you can see, they don't disclose their real gross profit because it's just the same as total revenue. Yeah, that's why the gross margins are everywhere 100%, because you calculate gross margin by dividing gross profit and total revenue. Yeah, and then when we go further, we have here net income margin, which is also very important to see how healthy the company is. And as you can see, they have an amazing net income margin, which should be over 20% for the last 10 years, except here in the Corona crisis when they had 13. So that's really amazing. Let's now mark all of the things that we analyzed with green or red, and based on that we will then decide how good the company is. So total revenue is obviously green. Gross margins I will put red because they are not disclosed, so we cannot see how good they are. Net income margin I will put green as well. Then when we go further to the balance sheet, we can see that their long-term debt is growing through the years, but here in the last, 5 years, it's relatively similar. So I guess it's fine, but it's still quite high. So I will put it as a red, just in case. Retained earnings are showing you how much money they reinvest back into the company instead of paying to the shareholders. And as you can see, they were investing quite a lot of money through the last 5-6 years when they were disclosing it, and then suddenly they were paying everything to the dividends here in 2020, which shows that they are respecting that policy of paying monthly dividends. So I guess this we will put green. And total debt to total equity is also one additional form that I will analyze in all the companies from now on. Ideally, you want this to be less than 50%, and here you can see that it's always more than that, even 106%. And total debt and total equity, as you can see, you can just analyze by dividing total liabilities with total equity. And here this is a red flag, obviously. And then in cash flow statements we analyze capital expenditure. This basically shows how much money they reinvest back into the I don't know, real estate, plants, machinery, and so on and so on, you know what I mean. And they don't disclose that, so unfortunately we cannot see that. Oops, sorry. But ideally you want this to be as high as possible through the years, because that means that the company is reinvesting their money back. So now here we see that we have 1, 2, 3 green flags and 1, 2, 3 red flags. So what does that mean now? I would buy this company, but with a caution, yeah? Because right now when it's trading at $43.77, it's a bit overpriced based on the debt that they have, because they have a massive fucking debt. As you can see here, almost 100%, okay, here is 100%, here 70, 70, 70, and so on and so on. In the last few years, they are increasing their debt, which means that they might potentially reinvest that money back into the business in order to grow. And I can confirm that partially because when we go to their main website, for example, here we can see the news. Here we can see, okay, they are investing some new, I don't know, portfolios, I think, or was it in Yahoo Finance? I'm not sure anymore. I think it was in Yahoo, yeah, let me see. Yeah, new portfolio 17 days ago, and so on and so on. And another reason why I would buy this stock is because of the monthly dividends. And obviously, if you want to get rich, the only way to get rich is by dividend investing, not trading, not bitcoins, not anything. Dividend investing is the safest one, and that's how Warren Buffett got rich, yeah? So, in my opinion, I would buy this stock just because I can get the dividends, you know. As you can see, their price is increasing here. And what else can we wish for? If we go to max, you can see the graph is growing. Here also in Ticker Terminal, which is the platform that I use to find stocks, 27% price return over 10 years, 2.5 CAGR, which is amazing. So basically, if you would, this CAGR, what does that mean is if you would invest each month into that company, this is the profit that you would get, plus all the dividends. So you know what to do now, bro. Do the hard work and see you on top of the world, bro.